Joining us now is our market master for the day, Vibhav Kapoor of IL&FS. Vibhav, hi, good morning. Good to have you in on the show as always. The thought process a couple of weeks ago was continue to invest into this market and it should be a buy on every dips. Does that still hold, or would you now start to get a bit cautious because of the developments that we've seen?
Now, one is that in the long term, things still look pretty good. As we've said earlier, the economy is probably bottoming out, so the cycle is turning up. So every dip certainly remains a buy. But the question is how much of a dip, because we've had a substantial rise in the market over the past several months, almost continuously. Valuations are no longer as cheap as they were, although for a long-term investor they might still be enticing. But from a 6 to 9 month point of view, I think the risk-reward ratio is not all that good as it was a few weeks ago. Also, as you said, oil prices have started going up, so that could be a new danger. And of course, the monsoons being deficient or predicted to be deficient also is a danger. So therefore, I would say you will get a reasonable correction at some point of time, sooner or later. We don't know when. If the market keeps on going up or does not fall before the budget because of budget expectations, then I would expect a substantial correction to happen after the budget. So keeping all this in view, I think fresh buying should be very much restricted now. And at every rise, one can take a little bit of profits and wait for a substantial correction to come whenever that happens and buy into that correction in a big way.
So the correction you're expecting would largely be post-budget?
Well, it's always difficult to say, if oil prices suddenly go up $4 or $5, you could have it even before the budget. But generally speaking, we've always seen in our markets pre-budget there is always a very strong sentiment, this time all the more because of the new government. So it may happen that that correction may not happen before the budget, but it's always difficult to time markets so closely. All I'm saying is that you will get a reasonable correction sooner or later, and you just need to wait for that before you buy in a bigger way.
Quantify reasonable, Vibhav. I mean, how much can get creamed off, or even at what level will you be a buyer then?
I'd say something like 8 to 10% from current levels.
Mm-hmm. And you will be a buyer then?
That would be a good point to buy, yes.
Okay. So what should the orientation be, Vibhav, now? Because we've seen a lot of the defensive stocks move higher and some correction in the cyclical names. Do you still buy the cyclical stocks on a dip, or do you go ahead and increase your positioning in defensive names like IT, etc.?
Now, on a dip, you certainly buy the cyclicals. I mean, if you get a 10% dip from here, you certainly go in for the cyclicals, because we are saying that the economy will turn around sooner or later and you'll have a good upcycle. But at this point of time, if at all you want to buy, I think it's only the defensives, particularly the IT stocks, which have not done much in the past few months, and valuations are now pretty reasonable. In fact, if you see, probably a lot of the IT stocks, and I'm talking of the big names except for maybe TCS, are not trading at multiples which are either equal to or even lower than the average Nifty multiple. And business conditions remain pretty good there. So I think at this point of time, if at all you want to buy, I would be a buyer only in IT stocks. And you, as far as cyclicals are concerned, you would really need to wait for a reasonable correction to happen before you buy.
Fair enough. But even among the cyclicals, we normally think of banks. There is this large number of infra companies or infra-related companies. Now many of them are even finding the QIP market open to them. Raising equity was so difficult for them up until a few months back. Is there anything over there that's attractive in terms of valuations already, or even over there only on a dip, or not even on a dip?
Well, some of these stocks have gone up quite a lot, 100%, 200%. So you need to really wait for them to correct again before you buy. And, let them raise capital. That's good. If they are able to raise capital, I think that would definitely lessen their problems a great deal. And then one can see what to do. So you have to be selective there. You have to, at this point of time, whether it's infrastructure or capital goods or other cyclicals, if at all one is buying something, you really need to be very selective and very stock specific. But on a general basis, as I said, I think a substantial correction is needed before you really go in for large scale buying.
All right. Vibhav, you're aware that our Money Control viewers and users can also ask you questions. We've got one such query. One Mr. Bhargav has written to us from Mumbai. He wants to know what investors should do about pharma stocks. What would be good buys currently in that space?
Well, I am not going to name any stock. But generally speaking, I think, again, pharma stocks, some of them look pretty reasonable, even the large ones. They have corrected substantially or have not gone up in the last few months. So you need to look at valuations. Their business models are still pretty good. Most of them are in the generic markets, which is doing pretty well. I mean, the only danger which the market was seeing is a substantial appreciation in the rupee, which could hit their earnings. And I don't see a very substantial appreciation in the rupee happening. So on a stock-specific basis, some of the large companies, and again, not to be specific, but things like Dr. Reddy, Lupin, IPCA, a lot of these companies are trading at reasonable valuations now and could be good investments.
Okay. So what could the range for this market be, Vibhav, for the rest of the year? I mean, I heard you mention that an 8 to 10% downside can't be ruled out. So that's somewhere around the 6,800 level. But what about the upside?
Yeah, I'd say about 7,000 on the downside would be a good level. On the upside, our target for March 2015 is about 8,300 on the Nifty. So, you could reach there earlier and then go back, or, the market could reach 8,300 at that point of time. But that's about the level we would expect the Nifty to be if things go well by March 2015. And that's exactly my point, that your risk-reward ratio is 10% on each side at this point of time, given a 9-month horizon. And therefore, it's not all that attractive. And every rise in the market is making it a little less attractive over a 9-month horizon. But if you are a really long-term investor, then of course things could be different, and you could definitely get better returns over a 2-3 year time frame.
So what is a bigger threat for this market now? Is it what's happening across the global space, or is it some sort of disappointment in the budget? If only something cosmetic comes through, then do you think this market will be heavily disappointed?
I don't think it's a question of cosmetic change in the budget or something like that. The fact that is that the market is expecting too many things. It's expecting all problems to be solved in one budget, which is just not going to happen, whatever the government may try. So there are great chances that a lot of this positive discounting will get a little bit of disappointment. Which is not a real disappointment. It's just the fact that, markets have gone up a lot, valuations have gone up a lot, and, things take time to improve, and one budget is not going to solve the entire problems of the country. So it's more of probably, something like a technical factor or a factor that the markets have run up well ahead of fundamentals and need to take a breather.
Okay, this is not certainly a money-making area, but where do you see bond yields? Do you think that they will top out at this 2.611 and we are going to see some seminal falls later on in the year?
Well, two things are happening there. One is inflation is still not coming down. And if the monsoons are bad or oil prices go up, then you again have this danger of inflation not only not coming down, but maybe inching up again, which is not good for bonds. And the second is oil prices. If oil prices shoot up suddenly, again you have a problem as far as bonds are concerned. The third is that yesterday we did see very high, or rather unexpectedly high inflation numbers in the US, which caused bond yields to go up. And if there are interest rate increases earlier than expected in the US by the market, then global bond yields could start to inch up again. And all these factors would be would not support a big fall in bond yields in the Indian markets.
Okay. Vibhav, what about some of the middling sectors? I mean, you broadly spoke about IT and the cyclicals, but what about, say, tire stocks, cement stocks, auto stocks? Where do you stand on these sectors?
Well, things like cement and autos are cyclicals, and they are related to the economy one way or the other. Now, again, you see cement stocks, for example, yes, over a long term, they obviously appear good if the economy starts to do well. But again, valuations have become really, really stretched in some of them. So the market is really pricing in a lot of positives. These positives, I hope, will happen. I'm sure they will happen, but they will take quite some time for them to actually happen on the ground. And therefore, in the meantime, the markets will either have to, go sideways for a, I'm talking of cement stocks now, for example, will have to go sideways for a prolonged period of time, or they will have to correct before you think of buying them.
The big trade since the start of the year, Vibhav, was to buy mid-caps. I mean, if you look at the Nifty, it's up 20% since the start. Mid-caps are up more than 35%. Do you think that trade has played out now?
Well, again, I wouldn't say mid-caps as a group mean much. In the initial phase, yes, and that's why all mid-caps went up. As you said, 35%. Some of them have gone up 100% also. But now you are coming into a phase where you'll have to be very selective in the mid-caps and take a stock-specific and sector-specific approach.
All right, Vibhav, thank you very much for joining us and with that very emphatic perspective that at this point in time the markets perhaps have gained all that they wanted to gain, and maybe post-budget or even pre-budget you could see a decent amount of creaming away of profits. That's the word coming in from Vibhav Kapoor.